We have a nice new report from the Financial Times actually detailing the history of Alameda and FTX's relationship, going back to a trade in 2021 and our favorite coin, mobile coin, which is a privacy token for the Signal application. Doesn't like This is a really weird story, so you're gonna have to sit back and hold on with me. Mobile coin at the time spiked to about $70 per coin, and this caused someone on FTX to take out a large loan on the platform, taking advantage of that large spike in the price of mobile coin to turn it into USD. And then, of course, the price of mobile coin went back down to earth, and this person was sitting with a large loan on their hands, and the collateral that they had given off to FTX was essentially worthless at that time. So it became a toxic asset. Alameda stepped in the hole to cover up that toxic asset, ended up being about $1 billion. This gives a lot of insights into both FTX's and Alameda's relationship, but also gives some insights into how FTX was using its liquidation engine, which they were using, going to Capitol Hill, going to regulators, saying like other people should use their liquidation engine, but it didn't work in this case. So why would anyone else need to use it or have to use it? Shows a lot of breaches of how any sort of margin exchange should work. The fact that they were not able to basically handle this shitcoin going to a large price and someone being able to use the exchange to get a large loan out. I think it's a pretty interesting story just going back. Of course, we know that there's been some more stories out there about like Lunaterra. There seems to be some bad protocol parameters around how they handled that. And then also Alameda with all its bad debt from a few other loans. Zach, I want to throw the story over to you. It brings me back to the Hash early days when we were talking about mobile coin. Kind of funny that this was happening in the background and nobody would know about it because it was behind security parameters and just behind the picture.
The thing that stands out to me is that it was a two-way street, the relationship between Alameda and FTX. It wasn't just FTX illicitly taking customer funds so that Alameda could use it to plug holes. Obviously, it was a reciprocal relationship where Alameda in this instance was helping FTX with a blunder on its end. So it does go to say that, these companies that are often claimed not to be linked, they tend to be linked. Crypto be like that, whether it's, the US outfit of a international exchange or other sort of affiliated or sister companies. You often see some of these relationships that are not as advertised, and it makes it really hard to cover the space because, these people can publicly assert that, hey, Alameda and FTX are separate. You should treat them as separate. But in reality, when it comes down to it and things like this are exposed through subsequent reporting at a time when their stocks are tanking, they're sort of, again, metaphorical stocks here, these reports come to light and they expose the fact that no, actually they were tightly interlinked from the jump. So that to me is obviously, I think, the standout in terms of what this story reveals. And I think it's something that, crypto projects need to be more mindful of. Governance, clear delineation between affiliated firms, that stuff is really important, right? You want to make sure that you get off the ground with a clear footing in terms of clear distinctions between affiliated firms so that you don't end up in a position like this where such things are blurred to the point of being unrecognizable. But Will, I saw your hand.
Yeah, I just want to point out that CoinDesk did ask FTX for comment and have not received word at this time. One other thing I want to point out is the similarity between the first two stories that we've done here. So Anchor Protocol with its minting of large amount of tokens, and then this failed ability to claw back collateral properly on FTX and Alameda back in the day. And that's because a lot of these systems work very similar, right? So for the Anchor Protocol, they were able to print a lot of these tokens, use that as collateral, and then claw funds out of the system. And that's a decentralized fashion. In this instance with FTX and Alameda, it's a centralized fashion where the price of a token went up. Someone was using that as collateral, able to take out a loan. And when the price of that token went back down to earth, they were able to keep that loan, the USD value. And the USD value of that loan was greater than the collateral that was then sitting on FTX at the time. So in many instances, these centralized and decentralized platforms, they actually have the same fundamental issue they're battling against. It's just about how you set those parameters. So when you talk about DeFi systems, you have to plug that into the code base, right? You have to make sure that everything is liquidated correctly, that nobody's able to get into your backend and change your systems willy-nilly whenever they want. On the centralized fashion, you have to have good standards, just like you said, Zach. There shouldn't be a conflict of interest between a hedge fund, which Alameda was, and FTX, the exchange that Alameda was operating on top of. And you should have very clear delineations on when things can be liquidated and when things were not. I think that's a huge part of this whole story with FTX, is that a centralized exchange did not follow its own rules. And that led to a lot of people becoming hurt in the same fashion that a lot of people in DeFi right now with bad parameters, financial primitives, so it's a little bit more excusable than with FTX. But in the same fashion, people get hurt either way. Zach, over to you, but also Jen's hand go up.
I just wanted to say that one more similarity here is that with big money on the line, people will go to great lengths to exploit these systems, be they centralized or decentralized systems, right? The whole thing here starts with some trader seeing the opportunity to significantly compromise the balance sheet basically of a crypto titan. In this case, they saw a mobile coin, they saw an opportunity to profit from it. They did so at the cost of this company. I guess also in DeFi, you see this, you see this, right? These are big prizes. They're big piñatas, and people are highly incentivized to game the system in such a way where they can profit. And that is something that I think is sort of true of the entire crypto space. When there's big money on the line, people go to great lengths to find ways to get some of that money. Sometimes through like explicitly devious and criminal means, sometimes through more fuzzy means. Like, was this trader acting maliciously when they did this thing with mobile coin, or were they simply acting on a market opportunity? And I think that's sort of those open questions, that fuzzy, that gray area that makes this space really interesting to think about. But just wanted to shout out that similarity as well, and I'll toss it to Jen for final thoughts.
This solidified for me that Sam Bankman-Fried should not be out there doing Twitter Spaces, doing interviews, as all of this information is being investigated and reported on by so many different people in the space. Just 2 days ago, we heard Sam Bankman-Fried say that Alameda and FTX were separate companies. To his knowledge, the two companies were more and more separate as time went on. This was just a year ago and shows how interconnected the two companies were. The other thing for me with this story is, okay, this is a year ago. The story says hundreds of millions, up to $1 billion were lost, could have been lost. And just a year ago, wasn't FTX spending massive amounts of money on marketing? They were sponsoring the Super Bowl, they're sponsoring sports teams. It just feels like if you know that there is this vulnerability in your business and this massive loss that you've had, why would you go out there and spend all of this money on this seemingly kind of fluffy marketing that you don't see that direct, return on? It just is baffling to me as we start to piece together all of the questionable business decisions. But Will, I saw your hand go up.
Yeah, I think reports like this from the Financial Times and just getting the inside scoop from employees who have been at FTX for a while will lend some light onto the practices of both those firms and like how they're intertwined. And then also like the marketing spend. So to your point there, like Tom Brady, Giselle, Steph Curry, Miami Heat Arena, all these spends were going on at the same time that Alameda and FTX were losing customer money. And what it seems like is Alameda was almost incentivized to lose customer money. Like they could not get liquidated on FTX. There was a provision and a clause that they could not get liquidated. So they're almost certainly always going to have some sort of bad debt on FTX, which is a very poor incentive for anyone else to be using FTX, and also just a pretty bad practice in general that put Alameda in this huge hole it's at. And I think it also really hurts SBF's apology tour right now. The fact that they were spending this much money for so long and that they were losing this much money. Certainly, SBF had to know about this issue, this $1 billion hole caused by this mobile coin failure. Even if he didn't know about the hole that was coming on from this, from August and September, when the price of all these tokens were crashing, and he said that Alameda had a huge hole and he didn't know about it. Well, you had to know about this $1 billion hole from 2 years ago or 18 months ago. Certainly had to know about that. So I think it puts a very large hole in his argument right now. Meanwhile, he keeps going on different apology tours, talking to every media outlet he can.